So let's bring into this conversation Australia's most experienced economist, Westpac's chief economist, Bill Evans. He was appointed in 1991 when Australia's last Great Recession was raging. In his time, he's seen 4 Reserve Bank governors, Bernie Fraser, Ian Macfarlane, Glenn Stevens and now Philip Lowe. So he is almost the perfect person to gain a perspective about the performance of the Reserve Bank, plus the differences and similarities between now and the lead up to that early 1990s recession.
Well, I think the number one parallel was that the shock to inflation came from a commodity, the oil shock this time. This time it's been oil and gas and food, but it's been a similar issue. And the issue in the 70s was that that shock fed into inflation, inflationary expectations took off, and it started to feed into wages, and we had that terrible situation of so-called indexation, where whatever happened to prices went straight into wages. Businesses felt they had very strong pricing power, and it got embedded in the system for such a long time, and most people were thinking more about inflation, more about what they were getting paid relative to someone else. And it was what I would call the lost decade. And Australia, of course, took another 10 years through the 80s as well to get out of it, whereas the US, through the courtesy of Paul Volcker, went to 20% rates and squeezed the inflation out in the early 80s. But of course, we went for another 10 years and we had that recession you referred to in the late 80s, early 90s, when finally inflation was squeezed out of the system. Very painful.
OK, but that was called by Paul Keating the recession we had to have. Today, are we likely to have a recession, or is it a recession that we have to have?
Look, I think it'll depend upon the resilience of inflation. And when I look at our forecasts, we are expecting that next year inflation will trend down to the sort of low 3s by the end of the year, coming from the 5.1 it is, and likely to print 5.9 when we get the next index. And that'll be because we're expecting oil prices to come back. We're expecting building materials costs to come back, particularly with the US construction cycle slowing down. And one of the big factors in building materials is that we used to import a lot from the US, and that was getting harder to get. And of course, we have to assume some sort of resolution over the longer term to the war in Europe that could take some pressure off food. So all of those big supply shocks we're expecting to ease. So over next year, certainly wages growth will be stronger, and we're looking for about 4% wages growth, but inflation to come back to 3%. And so this issue about we've got to get positive real wages growth, I think workers will get that next year. And of course, because we don't have such a centralised system as we had in the 70s, only about 2.7 million workers are on the minimum wage or on the modern award system out of about 10.7, whereas 4 million are on individual agreements and 4 on enterprise bargaining. So it's nowhere near as centralised. So I think we've got a good chance of avoiding that wage price spiral, which was the big problem for Australia in the 70s.
OK, so then take me to the level of household debt and also the level of government debt, because when you add all of those together, Australia is clearly a very heavily indebted nation. Is it capable of withstanding the interest rate rises that are required to squeeze the inflation out of our system?
I don't see the government debt being a major issue. Most of the projections suggest that gross debt will stabilise around 45% of GDP. In the US and the UK, of course, debt is 100% of GDP. So I don't think our problem relative to the rest of the world is in government debt, but certainly in household debt we're world class. And the sensitivity of Australian households to the Reserve Bank cash rate is extraordinarily high. If you take the US, those mortgages are 30-year fixed or up to 30-year fixed. So when the Fed raises rates and pushes up bond rates, you only affect new borrowers, whereas in Australia, 60% of borrowing of mortgages are floating rate, and of the 40%, 75% of those will be maturing by the end of 2023. So you can effectively say that 90% of household borrowers are exposed to the Reserve Bank cash rate, and as you point out, the level of debt has just exploded. So when I look at the comparison between when the Reserve Bank was last raising rates in 2009-10, when they went from 3% to 4.75%, I would say that 4.75% is now equivalent to around 2%.
Okay, so that being the case, does that put a cap on how high the Reserve Bank can raise interest rates without potentially damaging households, therefore damaging spending and therefore damaging the economy?
Well, I think from the Reserve Bank's perspective, they have to get that balance right. Their number one objective has to be to contain the inflation pressures. Now, we understand that most of those pressures are coming from the supply side, but there are also an issue. You get inflation when there's an imbalance between supply and demand. So demand is much higher than supply. Now, okay, so supply is low, but if you have to bring down demand in order to try and close that gap, that means higher interest rates. So they will have to do that, but the effectiveness of their rate hikes will be quite substantial. And what I'm expecting them to do, I'm expecting them to go 50 basis points in August, once they get confronted by another really large inflation print. But that'll only have rates at 1.85, and I think the so-called neutral level is between 1.5 and 2. Now, that's a lot lower than it's been in the past, for the very point you made about having such high levels of debt. And I think there's a very strong case to say once you're in the upper end of that neutral range, time to pause for a couple of months to assess exactly some of those factors that you're talking about.
When you first became the chief economist at Westpac, there was Bernie Fraser as the governor of the Reserve Bank, then Ian Macfarlane, then it was Glenn Stevens, now Philip Lowe. Hindsight being hindsight, there's almost been a beyond reproach sort of view of the Reserve Bank that they can never be wrong. Can the Reserve Bank in Australia be wrong in its settings? Can it be wrong in its communication to the markets?
Well, Ian Macfarlane and Glenn Stevens had some difficult challenges, but also had they were never confronted with a sort of the government spending $320 billion in a year to protect the economy against COVID. So over those two 10-year periods, both of them averaged inflation very close to the 2.5%. So from that perspective, they achieved their objective. Of course, Phil Lowe was for the first between 2016, when he was first appointed, up until 2019, inflation was well below the 2% range. So he's below that now. Of course, he's well above it. So he's had a much tougher challenge. And of course, he has been criticised for a number of the policies that were adopted during that incredibly difficult COVID period. And I think people have, in hindsight, we shouldn't forget how desperate we were back in that March period, where the government was talking about 20% unemployment rate. The economy was under a great deal of stress. The government spent so much money to insulate the economy from that, and the Reserve Bank decided to introduce not only very low interest rates, but also some unconventional policies, and that's where they've been criticised.
Okay, so hindsight being hindsight, is that criticism justified? Do you think was the communication, was the messaging from the Reserve Bank wrong at any point along this step? Was it too late to actually recognise the inflation that was coming down the track?
Well, I think one of the big issues was the so-called yield curve control policy, where the Reserve Bank said we'll buy 3-year bonds at the cash rate. In other words, we don't think the cash rate will be rising over that 3-year period. Now, that policy has been heavily criticised, but that had a tremendously stimulatory effect on the economy during that period. And what people don't realise is the Reserve Bank avoided quantitative easing bond buying in March and didn't take it up until November. I think that quantitative easing policy, printing money that all central banks around the world did, has been a major damaging policy at a time when governments were providing the support. The government was there to support incomes. I don't think it was the role of the central banks in that period to print money, which of course has ended up mainly showing up in asset prices, and now we're going to have to deal with the downturn in the asset prices as rates have to rise. So in many ways, the Reserve Bank, in delaying the introduction of quantitative easing, actually did quite a sensible thing.
Okay, but that being the case, it still did quantitative easing. And though many say, well, the inflation we see now is coming from overseas, it's oil prices, it's supply chains, all that type of thing, the reality is that the Reserve Bank bought back $350 billion worth of bonds which clearly is printing money, which is adding to the inflationary story today, which it's having to deal with.
Well, they held out against it in March when everyone was saying you've got to throw everything at it. They threw a different policy at it that I think was a lot more effective. And then, of course, by November, all of the other central banks were doing it. They felt that it was putting upward pressure on the Aussie dollar, and they felt that they had to go along with what other central banks were doing. So I actually felt that their initial policies in March showed a high degree of courage and independence rather than just following what everybody else was doing. Eventually they fell into line with that, and of course, as you say, they've got $280 billion that came through the bond buying program. They've got another $36 billion that came through the yield curve control program, and then another $44 billion that was there to settle the bond market down. So they do have, as you say, a very large bond portfolio at the moment. And of course, if you compare the rates at which they bought the bonds compared to where market rates are now, there have been some major losses.
I'll tell you what, Bill, it's always good to have a chat to you, and I appreciate your time today.
Thanks, Ross.